Hello CMA final students. So today I will be revising assessment of various entities chapter. You can expect at least 14 marks to 16 marks from this chapter. Very important. What are the topics that I am going to cover? Like section 115 BAC, default tax rates for individual HUF, AOP, BY, AJP, and section 115 BAA and 115 BAB. And I will be discussing taxation of AOP, BY, MAT and AMT, taxation of business trust, investment fund and securitization trust, advance tax. Along with this, I am going to solve the problems also. You can see the question bank, assessment of various entities. This question bank I freely shared with you. You can check in my website. You just log into my website. In free resources, please select CMA final December 25 English. You can see assessment of various entities question bank December 2025. You can download that QB and you can solve the problems. In this revision lecture also, I will be solving some 2-3 problems. So along with concept, listen to this lecture. We will also be doing the problems. Now let us get into the concept. Now there are certain benefits which are not allowed under section 115 BAC. What are those benefits which are not allowed under 115 BAC? Let us see them now. You can see following deductions or exemptions are not allowable under section 115 BAC. What are they? Salaries. You know there are 3 deductions under salaries. 16 1A standard deduction, 16 to entertainment allowance, 16.3 profession tax. If you are paying taxes under optional tax rates, old tax rates, all 3 deductions you can claim. But if you are paying taxes under default tax rates, only standard deduction is allowed. Okay. Remaining entertainment allowance and profession tax are not allowed as deduction under default tax rates. So we can tell one thing, standard deduction is allowed as deduction both under default tax rates as well as under optional tax rates. See, 50,000 standard deduction is available under optional tax rates. 75,000 standard deduction is available under default tax rates. Okay. That's the point. Next, leave travel concession. LTC benefit is also not available under default tax rates. HRA, you know HRA exemption, right? Under section 1013A, rent paid minus 10% of salary or 50% of salary in case employee living in Delhi, Mumbai, Kolkata, Chennai. If employee is living in other cities, 40% of salary. Next, actual HRA received, whichever is lower will be allowed as HRA exemption. HRA exemption is not available if SSE is paying taxes under section 115 BAC. Okay. Specified allowances exempt under section 1014 other than transport, travel, transfer, conveyance. See, there are 4 allowances. Travel allowance, conveyance allowance, transfer allowance, daily allowance. These allowances allowed both under default tax rates as well as under optional tax rates. Transport allowance. Transport allowance for physically handicapped employees. See, generally for physically handicapped employees, if any transport allowance is given, exemption is available. How much is the exemption? 3,200 per month or part of the month. So transport allowance for physically handicapped employees. Okay, for this transport allowance, how much is exemption? Exemption is 3,200 per month, and this exemption is also allowed both under default tax rates as well as under optional tax rates. Are you able to understand? So only 4 allowances: travel, conveyance, daily and transport allowance for physically handicapped employees. These 4 allowances are allowed as exemption both under default tax rates as well as under optional tax rates. Remaining allowances are allowed as exemption only under optional tax rates. For them exemption is not allowed under default tax rate. Next. Income from house property. You know, in case of self-occupied property, maximum interest allowed as deduction is 2 lakhs or 30,000. Even the 2 lakhs or 30,000 is not available if SSE is paying taxes under default tax rates. So simply, if SSE is paying taxes under default tax rates, interest on self-occupied property is zero. Interest on self-occupied property is not allowed as deduction. Next, in case of PGBP, additional depreciation is not available under default tax rates. So when you are calculating tax liability under default tax rates, don't claim additional depreciation. Next, section 35 AD, you know, specified business. In case of specified business, 100% of the expenditure, whether it is capital expenditure or revenue expenditure, is allowed as deduction under section 35 AD. Whatever specified business deduction is there, that is not available under default tax rates. Deduction for specific research. See, in case of scientific research, like if any donation is given to approved association, approved college or approved university, either for scientific research, social research or statistical research, such a donation given is not eligible for deduction under default tax rate. Next, clubbing of income. Whenever minor income is clubbed in the hands of parents, 1500 rupees exemption is available. That exemption 1500 rupees is not available under default tax rates. That means when you are calculating tax under default tax rates, when you are calculating total income under default tax rates, minor income is fully clubbed in the hands of parents without any exemption. Set off and carry forward. See, you know, loss from house property. Whatever the loss from house property is there, whether it is self-occupied property or let out property, under optional tax rates, loss from house property is eligible for inter-head set off up to rupees 2 lakhs. But under default tax rates, loss from house property is not eligible for inter-head set off. Loss from house property cannot be carried forward to subsequent years. Are you able to understand? So whatever the loss from house property is there, do intra-head set off. After doing intra-head set off, still if there is any loss, that loss is dead loss. You cannot set off against other head. You cannot carry it forward to subsequent years. So loss from house property, you cannot do inter-head set off. Inter-head set off is not available for loss from house property, and loss from house property cannot be carried forward to subsequent years. Chapter 6A deductions. See, under optional tax rates, all Chapter 6A deductions are available. Under default tax rates, Chapter 6A deductions are not available except 3 sections: 80CCD2, 80CCH2, 80JJAA. For these 3 sections, deduction is available both under default tax rates as well as under optional tax rates. Remaining Chapter 6A deductions are not available under default tax rates. So simply, under optional tax rates, claim all Chapter 6A deductions. Under default tax rates, only 3 deductions are available: 80CCD2, 80CCH2, 80JJAA. Remaining deductions are not available under default tax rates. Next, allowances of MPs or MLAs. Generally for MPs or MLAs, constituency allowance will be given, telephone allowance will be given. Whatever the allowance given to MLAs and MPs is there, that allowance is not taxable, it is exempt. But that exemption is available only under optional tax rates. If MLAs and MPs are paying tax under default tax rates, such exemption is not available. Next, deduction under section 10AA. Deduction under section 10AA is available only under optional tax rates. If you are paying tax under default tax rates, deduction under section 10AA is not available. Alternate minimum tax. Generally, other than company, remaining persons are required to pay AMT, alternate minimum tax. But alternate minimum tax provisions are not applicable if SSE is paying taxes under section 115 DEC. So only under optional tax rates, AMT concept is applicable. Under default tax rates, AMT concept is not applicable. Okay. So this is about 115 BAC. Next, certain benefits are not available under 115 BAB and 115 BAA also. Let us discuss them. See, you know 115 BAB, domestic company, it should be into manufacturing business, and its business should be started on or after 1st October 2019 and it should start manufacturing operations on or before 31st March 2024. If all these four conditions are satisfied, then domestic company can choose 115 BAB. So if 115 BAB is chosen, what is the benefit? Tax rate is very low, 15% plus 10% surcharge plus 4% HEC. So effective tax rate is only 17.16%. So many domestic companies, they choose 115 BAB if they are engaged in manufacturing business because they are required to pay very low tax, 17.16%. Okay, but if domestic company is paying taxes under section 115 BAB, some benefits are not available. What are the benefits that are not available? You can see, company should not claim following deductions or exemptions. If company is paying taxes under 115 BAB, then it cannot claim deduction under section 10AA. 10AA deduction is not available. It cannot claim additional depreciation. Additional depreciation benefit is not available. 33AB, 33ABA, tea, coffee, rubber reserve account. That deduction is also not available if company is paying tax under 115 BAB. Next, section 35(1) clause 2 subclause 1A, 35 clause 2AA, 2AB. See, in case of scientific research, in-house scientific research is allowed as deduction. But if any donation is given for the purpose of scientific research or social research or statistical research to any approved association, college or university, that donation given is not eligible for deduction for domestic company if domestic company is paying taxes under section 115 BAB. Next, 35 AD, specified business deduction is also not available if domestic company is paying taxes under 115 BAB. 35 CCC, 35 CCD, agricultural extension project, skill development project. For that, if you incur any expenditure, that expenditure is generally allowed as deduction under 35 CCC or 35 CCD, but the deduction is not available if domestic company is paying taxes under default tax rates. Okay. Next, Chapter 6 deductions are also not available if SSE is paying taxes under default tax rates except section 80 JJAA and ATM. So, in case of domestic company, it is paying taxes under section 115 BAB. Chapter 6 deductions are not allowed. Only two sections are allowed, 80 JJAA and ATM. Only these two deductions are available. Remaining all Chapter 6 deductions are not available if domestic company is paying taxes under 115 BAB or 115 BAA. You can see for 115 BAA also same concept. Even for 115 BAA, company should not claim following deductions. These deductions are not available. Another important point, if domestic company is paying taxes under 115 BAB or 115 BAA, then MAT provisions are not applicable. Minimum alternate tax provisions are. Now, shall we do some problems for your better understanding? See, this QB shared with you. Now, I am going to solve exam asked questions. So this is June 25 exam question 3A. Bablu, an Indian resident aged 34 years, started his retail trade business from 1st April 2024. He gives the following information to you relating to financial year 24-25. Net profit as per P&L account was 51,70,000. Net profit includes gross rent received. See, rent received, is it taxable under PGBP? No. Rent received is taxable under the head income from house property. So what we need to do, whatever the income from house property is there, that is to be reduced, that is to be disallowed while calculating PGBP, and it should be separately taxable under the head income from house property. So as net profit includes gross rent received, we need to disallow it. Okay. Disallow it. Interest debited to P&L account includes interest on loan taken for purchase of let out house property 2,20,000. See, income from rental income is taxable under house property. whatever the interest relating to house property is there, that is allowed as deduction under house property under section 24B. Why that interest is allowed as deduction under PGBP? No, that interest is not allowed as deduction under PGBP. It is allowed as deduction under house property. So whatever the interest debited is there, that is also to be disallowed. Additional information, deposit in PPF, this is eligible for deduction under ATC. Medical insurance premium paid for self and spouse, eligible for deduction under section 80D. Okay. Compute total income and tax payable by Bablu for assessment year 25-26 under default tax regime as well as under optional tax regime. So first, whatever the rent amount is there, see, he did not tell income from house property. What he said, gross rent received. That means gross rent received is annual value. From annual value, we can reduce municipal taxes, we can reduce deductions under section 24. We can reduce standard deduction at the rate of 30% of net annual value. We can reduce interest on borrowed capital. Okay. So under default tax rates, rent received is 1,20,000. Municipal taxes are not given. So we reduce it standard deduction 36,000. Interest on loan 2,20,000. And see, under default tax rates, there is loss. How much is loss? 1,20,000 minus 36,000 minus 2,20,000. There is loss of 1,36,000. But can you do interhead set off of this loss? No. Interhead set off is not available. Can you carry forward this loss? Carry forward option is also not available. That means what? Under default tax rates, loss from house property is not eligible for interhead set off. It cannot be carried forward to subsequent years. Did you understand? However, under normal tax regime, old tax regime, okay, you can carry forward this loss of 1,36,000. I told you that point also, loss from house property not eligible for interhead set off. It cannot be carried forward under default tax rates. Next, income from PGBP, interest we did add back because this interest is allowed under house property. So we have added back. And gross rent received is reduced. So PGBP income is same. Next, see, chapter 6A deductions. Chapter 6A deductions are available only under optional tax rates. They are not available under default tax rates. So maximum deduction allowed is 1,50,000 ATC deduction, and medical insurance premium paid for spouse and self maximum allowed is 25,000. So overall 1,75,000 is available. Even this 1,75,000 is available only under optional tax rates. Okay. So 1,50,000 and 25,000 is allowed as deduction only under optional tax rates. They are not allowed as deduction under default tax rates. Thereby you have calculated the total income. You can calculate the tax liability. So very important, based on the benefits that are not available under 115 BAC. A question is being asked in the exams for your attempt. December 25 also a question like this can come in the exam. Okay. Tara Private Limited Kanpur is a new manufacturing company incorporated on 16 January 2021 whose commenced manufacturing activity with effect from 1st April 21. Its net profit as per statement of P&L was 30,90,000 for the financial year 24-25 after debiting or crediting the following items. Depreciation as per Companies Act. Wait, let us go to the end. You are required to suggest company whether it should opt for provisions of 115 BAB or not by clearly showing relevant computation. See, we will calculate tax as per normal provisions. We will also calculate tax as per 115 BAB. Wherever tax is lower, that option is beneficial to choose. Okay. Now, depreciation as per Companies Act. As per Companies Act, depreciation that is not allowed, right? That is to be disallowed. Employer contribution as well as employee contribution to PF of rupees 11 lakh each for the month of March 2025 was deposited on 31st May 2025. What do you mean by this? See, employer contribution is allowed as deduction as per 43B. So, as per 43B, even though employer contribution is paid next year, If it is paid before ITR due date, allowed as deduction in current year. But employee contribution should be deposited within next 15 days from end of the month. So March contribution to be deposited by 15th April. But whether they deposited before 15th April? No, they deposited on 31st May. So whatever the employee contribution is there, that is also not allowed as deduction. That is also to be disallowed. Next, dividend 17 lakhs received on 15th October 24 from another company in which Sara Private Limited holds 32% shares. Amount spent for earning above dividend income. See, generally dividend income is not taxable under PGBP. Dividend income is taxable under IFOS. So whatever the dividend income is there, that is to be excluded while calculating PGBP income. And whatever the amount spent for earning dividend income is there, expenditure for earning dividend, that is also allowed as deduction under other sources. So while calculating PGBP income, you will disallow dividend and you will also disallow expenditure for earning dividend. Are you able to understand? Next, additional information. Normal depreciation as per income tax rules, that is allowed as deduction. Next, additional depreciation as per income tax rules. See, this additional depreciation is allowed only as per normal provisions. As per 115 BAB, additional depreciation is not available. So when you are calculating total income under normal provisions, claim additional depreciation. But when you are calculating total income as per 115 BAB, don't claim additional depreciation. Okay. Next, dividend declared and distributed rupees 20 lakhs. Date of declaration of dividend. See, here two things are there. Sara Private Limited received dividend. Sara Private Limited received dividend. How much is the dividend? From another Indian company, 17 lakh rupees, correct? 17 lakh rupees from another Indian company. Sara Private Limited received dividend and Sara Private Limited distributed dividend of 20 lakhs. Dividend of. That means what? Dividend is getting doubly taxed. Dividend is getting taxed in the hands of Sara Limited. Dividend is also getting taxed in the hands of shareholders when it is distributed to shareholders. So to avoid double taxation, whatever the dividend received is there, from this dividend, deduction is available. Now, dividend received is 17 lakhs, expenses 3 lakhs, net dividend is 14 lakhs, correct? Sorry, expenses 3,60,000. 3.6 lakhs. 13.4 lakhs net dividend, correct? Taxable dividend is 13.4 lakhs. Okay, small mistake is there. Here, expense is 3,60,000, make it 3,40,000. So, income from other sources, net dividend is 13,60,000. 3.4 lakhs. Net dividend is 13.6 lakhs. Now, the same dividend 13.6 lakhs is distributed to shareholders, right? That means on 13.6 lakhs, company should pay tax, shareholder also should pay tax. It is leading to double deduction. So to prevent double deduction, deduction is allowed under section 80M. Deduction under section 80M is equal to amount distributed to shareholders. Dividend passed on to shareholders. Or actual dividend received, whichever is lower. How much is dividend passed on to shareholders? 13.6 lakhs. Actual dividend received is 20 lakhs. Whichever is lower means 13.6 lakhs is allowed as deduction and taxable dividend is 0 in hands of Sara Private Limited, and total dividend is going to get taxed in the hands of shareholders. Okay. So with this explanation, you can go through the answer, you will understand. See, this is December 24 exam. Let us see now. Anand, an Indian resident aged 52 years, gives following information for the year ended 31st March 2025. Income from manufacturing business as per P&L account 10,60,000. Depreciation as per books, that is not allowed as deduction, that is to be disallowed. Next, depreciation as per Income Tax Act, that is allowed as deduction, right? But additional depreciation as per normal provisions allowed as deduction. But as per 115 BAB, additional depreciation is not allowed as deduction. Loss from speculation business 1,25,000. Public Provident Fund, this is eligible for deduction under ATC. Medical insurance premium, maximum deduction allowed is only 25,000 under ATD. Loss from speculation business can be set off only against profit from speculation business. But in question, there is no profit from speculation business. So whatever the loss from speculation business is there, that will be carried forward to subsequent years. Are you able to understand? Very simple. You need to calculate tax under default tax rates and optional tax rates. Under optional tax rates, you will claim all the benefits. But under default tax rates, deduction under ATD, ATC, that is not available under default tax rates. Additional depreciation, that is also not available under default tax rates. Okay. So only 3 adjustments. When you are calculating tax or total income under optional tax rates, claim all deductions. But when you are calculating total income under default tax rates, then don't claim additional depreciation, don't claim ATC, don't claim ATD. Only these 3 are the differences. You can go through the calculation. Next, taxation of AOP or BOI. If share of members is known, there is one type of calculation. If share of members is not known, there is another type of calculation. So, if share of members is known, if share of members is not known, if share of members is not known, then AOP is taxable at MMR, maximum marginal rate. Maximum marginal rate. How much is MMR? Under default tax rates, maximum marginal rate means highest tax rate. Under default tax rate, highest tax rate is 30%, highest surcharge rate is 25%, highest HEC is 4%. So how much? 30 plus 25% plus 4%, 39% MMR. Under optional tax rates, highest tax rate is 25%, highest surcharge rate is 37%, HEC 4%. So under optional tax rates, MMR is equal to 25 plus 37% plus 4%. Sorry, highest tax rate is 30%. 30 plus 37% plus 4%, 42.744%. Next, if share of members is known, then we have to calculate if total income other than share from AOP or BOI, other than share from AOP or BOI of each member is less than basic exemption limit, then AOP or BOI is taxable at slab rates. If total income other than share from AOP or BY of each member is of any member, any one member is greater than basic exemption limit, then AOP or BY is taxable at MMR. Taxable at maximum. So that is the thing. First of all, MAT. Sir, what is MAT? For whom MAT is applicable? MAT is applicable for companies. Sir, you said MAT is applicable for companies. There are a lot of companies in India, like private companies, public companies, listed companies, unlisted companies, government companies, foreign companies, domestic companies. So there are many companies, sir, for which companies MAT provisions are applicable. MAT provisions are applicable for all companies, whether company is private limited or public limited, whether it is domestic company or foreign company, whether it is a government company or non-government company. For every company, MAT provisions are applicable. Are you able to understand? Now, sir, what do you mean? Like, what if MAT provisions are applicable? If MAT provisions are applicable, then tax as per normal provisions or MAT, whichever is higher, that is required to be paid. Whichever is higher is payable to government. What happened? Many companies, as per accounts, they are showing huge profits, but as per income tax, they are showing very low profits and they are paying lower taxes. Sir, how is it possible? Under accounts, depreciation rate is low. Under income tax, depreciation rate is high. So they are claiming higher depreciation and they are claiming they are reducing their profits. So in accounts, they are showing higher profit. In income tax, they are showing lower profit. Many benefits are there. Deduction under section 35AD specified business. Deduction under section 10AA. 100% of profits are eligible for deduction. So under income tax, they are taking advantage of certain sections and thereby they are reducing their total income and they are paying very lower taxes. However, under accounts, they are showing huge profits. So at least they should pay minimum certain amount of tax, right? That's why MAT provisions are introduced. So what if MAT provisions are applicable? Normal tax or MAT, whichever is higher, that is payable to government. Sir, you said MAT. How to calculate MAT? MAT is equal to book profit into 15% plus applicable surcharge plus health and education cess. Sir, what do you mean by book profit? I will explain little later. Today, entire discussion, majority of the discussion is on book profit only. We will discuss book profit, not a problem. Now, book profit into 15% plus applicable surcharge plus health and education cess. If your unit is located in IFSC, International Financial Service Center, Gujarat, then concessional rate is applicable. 15% MAT is not applicable. 9% MAT is applicable. So what you will do, every year you will calculate. If you are a company, you will calculate tax as per normal provisions or you will calculate MAT. Whichever is higher, that is required to be paid to government. Now I will take one example. Let's say normal tax. Normal tax is 18 lakhs. MAT is 14 lakhs. Now out of these two, whichever is higher means 18 lakhs na. So 18 lakhs is payable to government. Now SSC will start arguing, sir, I am required to pay only 14 lakh rupees, but you are compelling me to pay 18 lakh rupees. Why are you asking me to pay extra 18 lakh rupees? So for that, income tax department gave clarity. Whatever the excess tax paid as per normal provisions, he is required to pay only 14 lakhs. But whatever the excess tax, 18 lakhs minus 14 lakhs that is paid is there, that will be treated as MAT credit. Okay. So this MAT credit can be carried forward and set off in next 15 assessment years. Carried forward and it can be set off in next 15 assessment. So did you understand? So every year we will calculate tax as per normal provisions. We will also calculate MAT. Out of these two, whichever is higher, that is required to be payable. If normal tax is greater than, if MAT is, here I did a mistake. Hold on. Let's reverse. MAT is 18 lakhs, normal tax is 14 lakhs. In this case, MAT is higher than normal tax. As MAT is higher than normal tax, whatever the extra tax that is paid to government is there, that will be treated as MAT credit, and whatever MAT credit is there, it can be carried forward and it can be set off in subsequent 15 assessment year. Now, this is year 1. Let's say this is belonging to previous year 22-23. For example, in previous year 23-24, scenario is like this. MAT is 10 lakhs, normal tax is 13 lakhs. Normal tax is 13 lakhs. Now, out of these two, whichever is higher means 13 lakh rupees. So, tax payable is 13 lakh rupees. Remember, every year we need to minimum pay MAT. So every year either you will pay MAT or if you will pay normal tax, but minimum you should pay MAT. So how much is MAT? MAT is payable. MAT payable is 10 lakh rupees. Over and above MAT, how much is excess normal tax? Excess normal tax is 3 lakh rupees. Against this 3 lakh rupees, you can set off MAT credit. How much is MAT credit available? MAT credit available is 4 lakhs. But whatever the MAT credit 4 lakhs available is there, out of this, you can set off only 3 lakhs. 3 lakhs you will set off. Balance 1 lakh, it will be carried forward to subsequent years. So in current year, how much you are required to pay? You are required to pay 10 lakhs. Are you able to understand? Minimum MAT you are required to pay to the government. So very simple logic. If MAT is greater than normal tax, if MAT is greater than normal tax, then how much is payable? MAT is payable. But whatever the difference is there, what is difference? Difference is MAT minus normal tax. The difference will be treated as MAT credit and it can be carried forward and set off for next 15 assessment. This is point number 1. Point number 2. If MAT is less than normal tax, in that case, minimum you are required to pay MAT. Minimum MAT is payable. Minimum MAT is payable. Whatever the excess normal tax is there, excess normal tax, you can set off against MAT credit. You can set off against credit. After setting off against MAT credit, still if there is any balance, that balance is payable. So this is the concept of sir. We will see one another example. In 21-22, normal tax, MAT. Normal tax is 20 lakhs, MAT is 25 lakhs. Here MAT is greater than normal tax. So how much is tax payable? Tax payable is 25 lakhs. Is there any MAT credit? Yes, there is MAT credit. How much is MAT credit? 5 lakh rupees. In 22-23, normal tax is 40 lakhs, MAT is 38 lakhs. So how much is payable? Minimum MAT is payable. So MAT means minimum 38 lakhs. How much is excess normal tax? Excess normal tax is 2 lakh rupees, correct? So minimum 38 lakhs is payable. Excess normal tax 2 lakh rupees. Against this 2 lakh rupees, you can set off MAT credit. How much you can set off? You can set off 2 lakhs. After setting off MAT credit, how much is balance available? Balance MAT credit available is 3 lakh rupees. Are you able to understand? Now, previous year 24-25. In previous year 24-25, normal tax is 60 lakhs, MAT is 51 lakhs. So minimum MAT is payable na. So minimum 51 lakhs is payable. I am writing 51 lakhs. How much is excess normal tax? Excess normal tax is 9 lakh rupees. Out of 9 lakh rupees, how much you can set off? MAT credit available is only 3 lakhs. After setting off, still how much normal tax is payable? 6 lakh rupees. So total tax payable is 57 lakh rupees. MAT credit available is 0. I hope with this example you got complete clear cut understand. Did you understand till here? Now, I will proceed further. What I said, every year tax as per normal provisions or MAT, whichever is higher is payable. Am I correct? Now, MAT calculation, book profit into 15% plus applicable surcharge. We have studied in case of domestic company, if total income more than 1 crore, surcharge rate 7%, total income more than 10 crore, surcharge rate 12%. If it is foreign company, total income more than 1 crore, surcharge rate is 2%, total income more than 10 crore, surcharge rate is 5%. That's what we need to apply, that surcharge, and we need to apply health and education cess. And 2-3 small points are there. If company, domestic company is paying taxes under 115 BAA or 115 BAB, in such case, MAT provisions are not applicable. Similarly, if insurance company which is taxable under section 115B, for that insurance company also MAT provisions are not applicable. Next, 44B, 44 BBA, BB, 44 BBA. You know, right? Non-resident shipping business, non-resident aircraft business. In case of non-resident shipping business, presumptive income is 7.5% of aggregate income. In case of non-resident aircraft business, presumptive income is 5% of aggregate income. So for those non-residents also, MAT provisions are not applicable. Okay. Now, next we are going to see how to calculate book profits. This is important. Our entire discussion is about this only. Calculation of book profit. Explanation to section 115G. Now, see, while we are calculating book profits, don't think about income tax P&L account. We are nowhere concerned about income tax P&L account. What is basis for us is Companies Act P&L account. Whatever Schedule 3 Companies Act P&L account is there, that we will take as base, and using that only we are going to do adjustments. So no relevance to income tax P&L account. For calculation of book profit, what we will consider is net profit as per Schedule 3 Companies Act 2013. If you are calculating MAT for banking company or power sector company or insurance company, they have separate acts na. As per those separate acts, you need to calculate. Are you able to understand? So as per those acts, as per those particular acts, you need to calculate the, you need to take whatever the profit as per Banking Regulation Act net profit is there, that you will take as base, or whatever the profit as per like insurance company net profit is there as per insurance regulations, that you will take as base. Okay. So first you will take net profit as per Companies Act 2013 and you will do some additions. You will also do some deletions. Okay. Thereby you are going to calculate the book profit. Whatever the book profit is there, on that book profit you are required to calculate MAT. First adjustment is whatever the income tax is there. Income tax related expenses are required to be added. Income tax or surcharge or health and education cess or interest. So whatever the amount that is there as per Income Tax Act, income tax, surcharge, health and education cess, interest, all these are required to be added back. Okay, and dividend distribution tax. So all these, whether they are paid or provision for income tax is also required to be added back. Sir, we will calculate PGBP income. In PGBP income also we will do like this only. In PGBP also we will add back provision for income tax, we will add back advance tax, we will add back health and education cess, we will add back interest. What is difference between PGBP calculation and book profit calculation? In PGBP, if you pay any penalty as per Income Tax Act, that is required to be added back. However, as per book profits, whatever the penalty that is paid under income tax is there, that is not required to be added back. So very simple, penalty under income tax. When you are calculating PGBP, you will add back. But when you are calculating book profit, you will no adjustment. Okay, you will not add back, it will be as it is. Another important point, under PGBP, any direct tax will be added back. Wealth tax, it is direct tax, that will also be added back. However, for calculation of book profit, wealth tax is not required to be added back. Only income tax is required to be added back. Are you able to understand? Second adjustment. See, there is, I will take another sheet for our adjustments. P&L account is there. P&L account debit to general reserve. So if you create any reserve through P&L account, you are reducing your profits. You are creating more reserves and you are reducing your profits. So through P&L account, if you create any reserve, whatever the amount transferred to reserve is there, that is required to be added back. You have written P&L account debit to general reserve 8 lakh rupees. That is required to be added back. So second adjustment is amount transferred from P&L account debit to any reserve. So if you transfer any amount from P&L account to general reserve or any reserve created through P&L account, that is required to be added back. Same is the opposite. See here what you did, you have transferred amount from P&L account debit to general reserve. Reverse means what? You have brought amount from general reserve account debit to P&L account 5 lakh rupees. In that case, like your income is getting increased, but it should not be increased. So what you will do? You will reduce. So first adjustment is amount transferred to P&L account from any reserve. That is first adjustment that you will reduce. Very simple. If you transfer any money to reserve, you are reducing profits. So whatever the amount transferred to reserve is there, that is not allowed, that will be added back. Same opposite. If you transfer any amount from reserve to P&L account, okay, that is also not correct. So whatever the amount that you transfer from reserve to P&L account is there, that will be that will be reduced. In that case, your income increases. To do the adjustment, it is to be disallowed. If income is disallowed, you will reduce it. Are you able to understand? So that is the adjustment. Dividend paid. Dividend paid is appropriation of profit. It is not expenditure, right? So in schedule 3 P&L account, if there is any dividend paid, that will be added back while you are calculating book profits. So dividend paid is required to be added back. Fourth one, provision for contingent or unascertained liability. that will also be added back. Sir, what do you mean by this? I will tell you. Provision for gratuity you have created. Is it allowed? That is not allowed. That will be added back. Under PGBP also, provision for contingent liability, provision for unascertained liability, you will add back. Under book profit calculation also, provision for contingent liability, provision for unascertained liability, you will add back. Under PGBP, any provision is required to be added back, whether it is contingent, ascertained or unascertained. Any provision that is created that is required to be added back while you are calculating PGBP income. However, when you are calculating book profit, if any provision is created on based on actuarial valuation, or if any provision is created based on a scientific basis, then whatever the provision that is created on scientific basis or created on actuarial valuation is there, that is not required to be added back. See, this is the difference you need to remember. Under PGBP, any provision you will add back. Okay, whether it is scientific basis, whether it is actuarial valuation, any provision you will add back while you are calculating PGBP income. But when you are calculating book profit, if any provision is created on actuarial valuation, that is not required to be added back. Any other provision of contingent liability or unascertained liability, that is required to be added back. I will tell you one example. After 10 years, company is required to pay gratuity. How much gratuity is payable? I recruited one actuarial valuationer. I have valued the provision for gratuity, and whatever the provision for gratuity that I have created based on actuarial valuation is there, this will be added while calculating PGBP income, but this will not be added while calculating book profit. Are you able to understand? So very simple, all provisions are required to be added back as per PGBP, but any provision created based on scientific basis or on actuarial valuation, that will not be added while calculating book profits. Remaining provisions will be added back. Are you able to understand? Next, there is one interesting thing. Provision for bad debts. Whether provision for bad debts is allowed as per PGBP. As per PGBP, provision for bad debts is disallowed, right? However, as per Companies Act, book profits also it is disallowed. But what happened? There is one case law. In that case law, SSC challenged income tax department. What SSC said, sir, provision for contingent liability or unascertained liability, that is required to be added back. Provision for bad debts, when provision for bad debts is created, this is created against asset. Am I correct? This is created against debtors. Whether debtors are liability, debtors are not a liability, right? So he won the case in Supreme Court. He said that what he said, you know, provision for contingent liability is required to be added back, but provision for bad debts, it is created against debtors. Debtors is not a liability. So he won the case. Provision for bad debts is not required to be added back. Then income tax department realized the loophole. What is loophole? If you create provision against liability, that is required to be added back. But provision for bad debts is not created against liability, na? It is created against asset. So income tax department realized that there is loophole, and income tax department added another new point in the next finance act, that is provision for diminution in valuation of diminution in value of asset or investment. So against asset value or investment value, if you create any provision, that is also required to be added back. AS 13 investments is there. So if you make any investment, at the end of the year you will value it. Okay. So if there is any loss compared with market, that for that loss you will create provision for loss on investment, that is also required to be added back. So not only against liability, even against any asset, if you create any provision, that provision is required to be added back while you are calculating book profits. This is something very interesting. Income exempted under section 10, 11 and 12. Income exempt under section 10, 11, 12, that is required to be reduced. Agricultural income is there. Agricultural income is not taxable. It is exempt. But accountant does not know na what accountant will do when he is preparing P&L account. He will credit agricultural income. So whatever the agricultural income that is credited is there on this MAT is not applicable. As MAT is not applicable, whatever the agricultural income is there, that will be reduced while calculating book profits. So whatever the income that is exempt under section 10, 11, 12, that income is to be like reduced while you are calculating book profit, because as that income is not taxable, on that income MAT is also not applicable. Are you able to understand? Similarly, if there are any agricultural expenses, see, income is exempt, it is reduced. So if there are any expenses relating to agricultural income, they are also not to be allowed as deduction, right? So whatever the expenses relating to income exempt under 10, 11, 12 sections are there, those expenses are to be added back while you are calculating book profits. Are you able to understand? So to this you will add back expenses of income exempt under section 10, 11, 12. So whatever the expenses relating to incomes exempt under section 10, 11, 12 are there, they are required to be added back while you are calculating book profit. Loss of subsidiary company. Whatever loss of subsidiary company is there, that is required to be added back while you are calculating book profit. Otherwise, it becomes a loophole. He will intentionally create subsidiary company. He will book losses there. Thereby, he can reduce book profits. So that's why what lawmaker said, if there is any provision for loss of subsidiary in Schedule 3 Companies Act, that is required to be added while you are calculating book profits. Deferred tax. In your FR, in days, you have studied about deferred tax, right? So, if there is deferred tax liability, what is the entry that you will pass? P&L account debit to deferred tax. Similarly, if there is a deferred tax asset, what is the entry that you will pass? Deferred tax account debit to P&L account. Whatever deferred tax is there, that is not allowed. Okay, so if there is a deferred tax asset, what is the entry that you will pass? Deferred tax asset account debit to P&L account, that will be reduced. If there is deferred tax liability, what is the entry that you will pass? P&L account debit to deferred tax. However, deferred tax liability expenditure is not allowed. For that, as it is not allowed, what you will do? You will add back deferred. Next, income of AOP BY. Whatever income of AOP BY is there, that is also to be excluded. Sir, why income of AOP BY is to be excluded? AOP BY already paying taxes at maximum marginal rate. As AOP BY is already paying taxes, what after payment of taxes, balance income we have received. So whatever the share of income that we are getting from AOP or BY is there, that income is after payment of taxes. So as it is after payment of taxes, again MAT provisions are not able to understand. So whatever the share of income from AOP or BY is there, that is to be excluded. Similarly, if there is any expenditure relating to share of income from AOP or BY, that is required to be added back. See, income you are disallowing, whatever the expenditure relating to that income is there, that is also required to be added back. That is next adjustment. Okay, 10th one. Here it is 5th one. Royalty income taxable under section 115 BBF at the rate of 10%. So if you are resident patent holder, as per section 115 BBF, whatever the royalty income that you receive, that is taxable at very nominal rate of 10%. So royalty income 115 BBF, they said they will levy tax of 10%. Again, by MAT, if they levy 15%, it's like cheating. Na? See, I am getting royalty income, I am required to pay 10% tax. Again, they are only coming and they are telling me you are required to pay 15% tax. What will I tell? You are doing cheating, correct? Cheating kar rahe tu, correct? So that's why if there is any royalty income which is taxable at 10%, which is less than MAT, then on that MAT is applicable, on the tax rate of 10% is only applicable. So that will be reduced while calculating book profit. Similarly, if there is any expenditure for royalty income taxable at the rate of 10%, that expenditure is also required to be added back. See, royalty income is reduced, so corresponding expenditure is also to be disallowed. Na? That's why expenditure relating to royalty income we will add back. Are you able to understand? Next adjustment is depreciation. Whatever the depreciation is there, depreciation will be add back. Sir, in PGBP, what will we do? We will add back Companies Act depreciation. We will reduce income tax depreciation. But careful, when you are doing calculation of book profits, you will add back Companies Act depreciation. You will also reduce Companies Act depreciation. Companies Act depreciation minus depreciation on revalued assets. Very important adjustment. You will get confused, but you should not get confused. What I said, as per PGBP, add back Companies Act depreciation, reduce depreciation as per Income Tax Act. But when you are calculating book profits, then you are playing with Companies Act P&L account. You should add back Companies Act depreciation. You should reduce Companies Act depreciation minus depreciation on revalued assets. For example, let's say depreciation is 400 crores. Out of this 400 crores, like normal depreciation is 350 crores. Depreciation on revalued assets is 50 crore rupees. What will you do? You will add back 400 crores, but here you will not add back 400 crores. You will reduce 400 crores minus depreciation on revalued assets 50 crores. So how much you will reduce? You will reduce only 350 crores. Are you able to understand? So you will add back Companies Act depreciation. When you are reducing, don't think of income tax depreciation. You need to reduce Companies Act depreciation only, but after reducing depreciation on revalued assets. Are you able to understand? I hope this depreciation concept you are very clear. This adjustment pakka will come in examination. So please be very careful. Okay. So what I said, PGBP, add Companies Act, reduce income tax. Book profit, add Companies Act, reduce also Companies Act, but after reducing depreciation on revalued assets. Okay. Next one, this is also a bit important. Transfer from revaluation reserve, but you will reduce only to the extent of depreciation on revalued assets. Depreciation on revalued assets. Only that will be. For example, I will take one example. P&L account is there. In P&L account, in the same example, we have discussed example na 400 crores is depreciation. Out of that, 350 crores is normal depreciation. 50 crores is depreciation on revalued assets. Correct? What happened? Revaluation reserve account debit to P&L account, 90 crores entry was written. Okay. So as per Ind AS, I think Ind AS 16, right? PPE. Am I correct, Monish? What is Ind AS for PPE? Is it Ind AS 16? I feel there is some lag between you and me. So Ind AS 16, right? Perfect. So as per Ind AS 16, I don't know the treatment, but let us assume the entry written is revaluation reserve account debit to P&L account 90 crore rupees. But how much is depreciation on revaluation? Depreciation on revaluation is 50 crore rupees. So when you are calculating book profits, how much you will reduce? You will reduce only 50 crore rupees. Are you able to understand? Let's say revaluation reserve account is 40 crores. How much is depreciation? Depreciation on revaluation assets. Depreciation on revaluation assets is 50 crore rupees. In this case, how much you will reduce? You will reduce total 50 crores. Okay. Next, let's say depreciation on revalued assets is 60 crores. How much you will reduce? You cannot reduce 60 crores. Maximum you will reduce is only 50 crores. In this case, how much you will reduce? You will reduce 40 crore rupees. Similarly, revaluation reserve is 120 crore rupees. But how much is depreciation on revalued assets? 50 crores. How much you will reduce is only 50 crore rupees. So if any amount is transferred from revaluation reserve to P&L account as per Ind AS 16, then total amount transferred from revaluation reserve, you cannot reduce 90 lakh rupees. Okay, that's not correct. Maximum you can reduce is to the extent of depreciation on revalued assets. That is another adjustment. So if any amount is transferred from revaluation reserve to P&L account, don't reduce total amount, either that amount or depreciation on revalued assets, whichever is lower. Okay, so only to the extent of depreciation on revalued assets it will be reduced. Profit of SIC industrial company. SIC industrial. See, already it is sick company. It is not making any profits. It is into losses. But from government grant, it came into profits. Just now it came into profits. Again, if you levy MAT, it will be burdensome. So whatever the profit of sick industrial company is there, that will be reduced. Next point. Foreign company is there. For foreign company, in NR taxation, concessional tax rates are there. Capital gains, interest on security, they are taxable at less than 15%. So those which are taxable at less than 15%, on that if you apply, if you levy MAT 15%, they will tell cheating. Okay, Nirmala Sitharaman went to foreign. She tell invest in India, tax rate is only 10%. After they come to India, she is telling MAT is applicable, 15% tax is payable. Now they will tell Nirmalamma is cheating. Okay, you said 10%, again you are levying MAT 15%. So in order to maintain international relations, so whatever the income that is taxable at less than 15% in case of foreign companies there, that will be reduced. On that MAT is not applicable. On that reduced tax rate is only applicable. Are you able to understand? Similarly, corresponding uh, adjustment, expenses of foreign company relating to capital gains or interest on securities which are taxable at less than 15%. For those assets, if any expenditure is incurred, that is also not allowed. If income is there, that is reduced from book profit. So if there is any expenditure, that will also be added back, that is disallowed from book profits. Okay, so that needs to be added back. That is next adjustment. Next. One benefit was given to companies, brought forward losses or unabsorbed depreciation, whichever is lower, it can be reduced. Sir, brought forward losses as per Income Tax Act? No. Brought forward losses as per Companies Act, unabsorbed depreciation as per Companies Act. Out of these two, whichever is lower is there, that can be reduced. Are you able to understand? But there are two cases. For example, insolvency application. Any company for which insolvency application is made, or any company for which section 241 and 242 of Companies Act is applicable. Okay. So in these two cases, like brought forward losses and unabsorbed depreciation, both are allowed as deduction. Both are allowed as deduction. What I said, generally conjunction is or. What is general conjunction? Or. But in two cases, conjunction is and. In two cases, conjunction is and. What are those two cases? Section 241, 242 of Companies Act are applicable, or any company became like it did not become insolvent, insolvency application was filed. In these two cases, both, okay, brought forward losses, unabsorbed depreciation, both you can claim as deduction. Are you able to understand? So these are the adjustments. I think one more adjustment is also there. Sorry, two adjustments are there. I will tell. See, till now, how many adjustments we have seen? We have seen 12 adjustments. What is interesting is all these 12 adjustments, they need to be added back when credited to P&L account. They need to add it back, sorry, when debited to P&L account. Okay, but in one situation, even though amount is not debited to P&L account, still it is required to be added back. What is that one? I will explain. See, there is one asset. The asset cost is 20 lakh rupees, but fair market value is 90 lakh rupees. I don't want to pay tax. Now, how much is my profit? If I sell in the market, my profit is 70 lakh rupees. On this 70 lakh rupees, I don't want to pay tax. What will I do? There is one hack. Normally, as per accounts, what will you do? Accounts, you will write bank account debit 90 lakhs to asset account 20 lakhs to P&L account 70 lakhs. Correct? Whatever this 70 lakhs is there, on this MAT is applicable now. So if I disclose, if I credit 70 lakhs to my P&L account, on that 70 lakhs, I am required to pay minimum alternate tax. Now how to avoid that minimum alternate tax? I have one hack. What is that hack? What I will do? Asset, how much is asset cost? 20 lakhs. Fair market value 90 lakhs. What I will do? I will do revaluation. I will write the entry asset account debit to revaluation reserve account 70 lakh rupees. Now I will sell the asset bank account debit 90 lakhs to asset account 90 lakhs nullified na. Asset account is like 70 lakh plus 20 lakhs 90 lakhs, it got nullified. And whatever my profit is there, revaluation reserve, this I will directly transfer to general reserve without touching P&L account. Are you able to understand the loop? What will I do? Revaluation reserve account debit to general reserve account 70 lakh rupees. So in this entire transaction, did I touch P&L account? Did I touch P&L account? No, I did not touch P&L account. I did not touch P&L account. Am I correct? So in this entire transaction, I did not touch P&L account at all. I did not touch P&L account. So this has become a loophole. Somehow Nirmalamma came to know about this loophole. Nirmalamma said, so whenever you sell any asset, with regard to that asset, if there is any balance in revaluation reserve, that should be credited to P&L account. If you fail to credit it to P&L account, it will be added while you are calculating book profits. Are you able to understand? That is 13th adjustment. The 13th adjustment is on sale of asset. Whatever corresponding revaluation reserve is there, that should be credited to P&L account. If not, if it is not credited to P&L account, that will be added in calculation of book profits. So I told you the loophole. I also told you how it was countered by Nirmala Sitharaman. Next, one last adjustment is there. So I hope you found this example interesting. Last example is relating to business trust. Let's say there is MRF Limited and there is it invested in My Home Limited. Actually, My Home Limited is basically a real estate company. Real estate company. So MRF Limited invested in My Home Limited real estate company. Now, MRF Limited wants to form business trust. How it will form business trust? MRF Limited is there. So it is having shares of My Home, right? Shares of My Home. Now what it will do? What MRF Limited will do? MRF Limited is having shares of My Home Limited, right? So we can tell My Home Limited is SPV, Special Purpose Vehicle. It will create business trust. When creating business trust, actually MRF Limited is having shares of My Home Limited. What MRF Limited will do? MRF Limited will transfer shares of My Home Limited to business trust. In return, MRF Limited will get units of business trust. So here there is exchange. What MRF Limited is doing, it is actually shareholder of My Home Limited. It is transferring shares of My Home Limited to business trust and business trust is giving units. So there is exchange here, exchange of My Home shares for getting units of business trust. Whatever this exchange transaction is there, this exchange transaction is not a transfer and no capital gains are required to be calculated. No capital gains are required to be calculated. But the point here is shares transferred are 40 crore rupees, units received are 45 crore rupees. There is a notional gain. How much is notional gain? Notional gain is 5 crore rupees. Tell me, what, for suppose I am MRF Limited. What I am doing? I am transferring my shares in My Home Limited to business trust. From business trust I am getting units. How much worth of shares I transferred? 40 crores. How much worth of units I received? 45 crores. Now I got profit of 5 crore rupees. But did that 5 crore rupees realized? Those 5 crore rupees was not realized. So at the time of exchange of SPV shares for getting units of business trust, if there is any income or loss, that is notional in gain or notional loss, whatever the notional gain is there, that will be reduced. If there is notional loss, that will be added back while calculating book profit. Are you able to understand? So last adjustment, notional gain. If there is notional gain, that will be reduced. Notional gain on exchange of shares of SPV to receive units of business trust. That notional gain is to be reduced, and whatever the notional loss is there, that notional loss will be added. Sir, you said 5 crore rupees is notional gain. It is not realized. In current year, it was reduced from calculation of book profits. Is it not at all taxable? Profit 5 crores is there. Is it not at all taxable? Answer is no. In future, I will sell these units, right? the year in which I sell the units, whatever the total gain that I receive on the total gain in the year of realization, in future when I realize 100% of profits, in that year I am required to pay MAT. So whatever the gain, final gain, realized gain is there, so realized gain is to be added. Realized gain on sale of units of business trust, that is to be added. If there is finally if I get any loss, so in the year of realization, if I get any loss, realized loss, so realized loss on sale, final sale, if there is loss, that I will, are able to understand? So these are all the adjustments which you need to do for calculation of. So shall I start today's class quickly? Good evening, good evening. Welcome. Long gap, we are meeting again. Today I am live from Hyderabad. Today a new batch was started, CA Inter, CMA Inter for May 2020. That batch was done and I came here. Hyderabad traffic was very hectic. Okay, I will start now. See, today first I will discuss about taxation of business trust. Then I will discuss about investment fund, taxation of investment fund. Then I will discuss about taxation of securitization trust. Then I will discuss advance tax. Then I will discuss interest under section 234A, 234B, 234. So these are the topics that are going to be revised in today's class. First, let us start with taxation of business trust. Hi Varun, good evening. Taxation of business. See, have you ever dreamt of owning a mall? See, we can buy flat, we can buy one house, but have you ever dreamt of purchasing one big mall? Have you ever thought, if I am the owner of this big mall, I would be receiving rental income like that? So generally we can maximum purchase house or we can maximum purchase flat like that. But like we middle class people, we do not have that much of money to purchase one big mall or one big real estate property. That's not possible. So that's where comes the concept of business trust. Business trust is like a mutual fund. Let's say I wanted to invest in MRF shares, Reliance Limited shares, Tata Limited shares, Wipro Limited shares with just 200 rupees. How can I invest with 200 rupees in these four big company shares? That is not possible. So what I will do, I will deposit 200 rupees. I will purchase units of mutual fund with 200 rupees. Mutual fund will invest in these four company shares. So a person can own portfolio of multiple company shares. That is possible because of intermediary mutual fund. In the same way, if you want to own a very big real estate property or a very big mall, that is also possible through buying units of business trust. Are you able to understand? So business trust concept is also like a mutual fund only. Are you able to understand? Let's say unit holder is there. What unit holder will do? and there is business trust, and there will be real estate property. Now, unit holder, what he will do? He will invest. Invest means what? He will purchase units of business trust. What business trust will do? Business trust will invest that money in real estate property. Okay, real estate property or one big mall. Now, from that big mall, rental income will be received by business trust. Na? Whatever the rental income that is received by business trust is there, such rental income will be passed on to unit holder. This is the concept of business trust. Are you able to understand? So if I purchase, let's say there is one very big property. DLF is a very big real estate company. DLF is constructing one mall, DLF mall. In that DLF mall, I wanted to invest. Can I purchase any floor in DLF mall? That is not possible. It is very costly. Now what DLF mall will do? It will create a business trust, DLF business trust. I will purchase units of DLF business trust. So my money will go to business trust. Business trust will invest in that mall, real estate property. So from that property, like business trust will receive the rental income. Whatever the rental income received by business trust is there, that will be passed on to the unit holder. This is the concept of business trust. Are you able to understand? Next, shall we discuss taxation of business trust? I hope you understood what business trust means and how that concept works. If you understand, please respond. Then I will discuss taxation of business. Taxation of business trust. Let's say there is one SPV, special purpose vehicle. Special purpose vehicle means it is a company in which business trust holds greater than or equal to 50% shareholding. Let's say there is business trust. This business trust is holding greater than or equal to 50% shareholding. Not greater than or equal to 50%. I think it is 50% or more. So not equal to, greater than 50%. If business trust invests more than 50% shareholding in SPV, then we call that Indian company. SPV means it's nothing but an Indian company in which business trust holds greater than 50% shareholding. Then we call that Indian company as business trust, and then there will be unit holder. Now the point is SPV is nothing but Indian company, right? For example, Indian company is paying taxes at normal rates. What are the taxes applicable to Indian company? Taxes applicable to Indian company is domestic. Indian company means nothing but domestic company. So we need to check turnover of previous year 20 to 23. If it is less than or equal to 400 crores, then tax rate applicable is 25%. Otherwise, tax rate applicable is 30%. So Indian company is paying taxes at the rate of 25% or 30%. Now, what Indian company will do? Indian company will give dividend to business trust. Such dividend is exempt in the hands of business trust. Whatever the dividend in the hands of business trust is there, such dividend will be passed on to unit holder. Such dividend is also not taxable. Such dividend is also exempt in the hands of unit holder. Both these exemptions are per under section 1023 FT. So very simple. SPV, Indian company in which business trust holds 50% or more than 50% shareholding. Then in that, if that SPV gives any, that SPV is paying taxes at 25% or 30%, that SPV is paying dividend to business trust, the same business dividend is passed on to unit holder. Total dividend is exempt in the hands of unit holder. It is not at all taxable. Now, case 2. Indian company is paying taxes under section 115 BAA. You know concessional tax rates, right? 115 BAA, base tax rate 20%, 22% plus default 10% surcharge plus 4% HEC, 25.168%. Do you remember? So paying taxes under section 115 BAA. So if SPV is paying taxes at concessional rate, then whatever the dividend given is there, whatever the dividend given by SPV to business trust is there, such dividend is exempt in hands of business trust. But whatever the dividend distributed by business trust to unit holder is there, such dividend is not exempt, such dividend is taxable. Are you able to understand? Sir, what is the tax rate? If the SSE is non-resident or foreign company, tax rate applicable is 10%. If SSE is resident, then tax rate applicable are normal tax rate. Next, sir, but here it is taxable na. As it is taxable, TDS is required to be deducted. In case 1, domestic company is paying taxes at normal tax rates, 25% or 30%. That's why dividend is not taxable in the hands of business trust. It is also not taxable in the hands of unit holder. But in second case, SPV is paying taxes at concessional rates. That's why whatever the dividend received, it is exempt in the hands of business trust, but it is not exempt in the hands of unit holder. It is taxable in the hands of unit holder. Are you able to understand? Now, so what is the tax rate for non-resident or foreign company? Tax rate is 10%. For resident, tax rate applicable are normal tax rate. Now, here TDS is also required to be deducted. What is the rate of TDS? TDS under section 194 LBA, rate of TDS in case of non-resident, rate of TDS is 10%, non-resident or foreign company. In case of resident, rate of TDS is, are you able to understand? So very simple. We are speaking only about dividend income. We are not speaking about other incomes. So if SPV pays tax at normal tax rates, dividend is exempt both in hands of trust as well as unit holder. SPV paying taxes at concessional tax rates, dividend exempt in the hands of business trust but taxable in the hands of unit holder. Tax rate in case of NR or foreign company 10%, in case of resident normal tax rate. As it is taxable, business trust is required to deduct TDS under section 194 LBA at the rate of, in case of non-resident or foreign company, 10%. In case of resident also, TDS rate is 10%. Are you able to understand? Yeah, 50% or more. I think 50 greater than or equal to 50% only. Initially I wrote correct, but bit of confusion. So did you understand dividend income? Shall I explain about other incomes? Now, same concept, unit holder, business trust, SPV. This time SPV is paying interest income to business trust. Whatever the interest income paid to business trust is there, such interest income is exempt in hands of business trust under section, exempt in hands of business trust, and no TDS is required to be deducted. As that income is not taxable, that income is exempt, no TDS is required to be deducted. And the same interest will be passed on to unit holder na. Whatever the interest passed on to unit holder is there, this interest is taxable in the hands of unit holder. That is taxable in the hands of unit holder. Sir, what is the tax rate? In case of non-resident or foreign company, tax rate is 5%. In case of resident, tax rate is normal tax rate. Now, it is taxable in the hands of unit holder. Na? So, business trust, for this interest, business trust is required to deduct TDS. Is required to deduct TDS at the rate TDS under section 194 LBA. In case of non-resident or foreign company, TDS rate is 5%. In case of resident, tax rate is 10%. Are you able to understand? So for interest income, see, dividend income, interest income, rental income, all three are exempt in the hands of business trust always, but they are taxable in the hands of unit holder. Like interest income is taxable in the hands of unit holder. If unit holder is non-resident or foreign company, for interest tax rate is 5%, for dividend tax rate is 10%. For resident, tax rate applicable is normal tax rates. As it is taxable in the hands of unit holder, business trust is required to deduct TDS under section 194 LBA. For non-resident, TDS rate is 5%, for resident, TDS rate is 10%. So did you understand about interest income? Now shall I explain further? Same. Now we will discuss about rental income. Unit holder is there, business trust is there. This time business trust did not invest in special purpose vehicle. Business trust purchased real estate property. Let's say 1 lakh people, 1 lakh units are sold, 10 crores are 10 crores were taken. Using this 10 crore, one mall was directly purchased, real estate property. Now, from this real estate property, rental income will be received by business trust. Now, this rental income is exempt for business trust. That rental income is not taxable in the hands of business trust. As rental income is exempt, no TDS is required to be deducted by the payer of rent, real estate property. But the same rental income will be passed on to unit holder. That rental income is taxable in the hands of unit holder. This is taxable in the hands of unit holder. Sir, what is the tax rate? In case of non-resident or foreign company, tax rate applicable is rates in force. In case of resident, tax rate applicable is normal tax rate. See, this rental income is taxable in the hands of business trust in the hands of unit holder So business trust, before passing on rental income to unit holder, business trust is required to deduct TDS. TDS under section 194 LBA. What is the rate of TDS? In case of non-resident or foreign company, TDS rate is rates in force. In case of resident, TDS rate is 10%. Are you able to understand? So this is the TDS rate applicable for rental income. So if rental income is distributed by real estate property to the business trust, it is not taxable in the hands of business trust. When it is passed on to unit holder, it is taxable in the hands of unit holder. Tax rates applicable are for both resident and non-resident. Tax rates applicable are normal tax rates, whatever the rates in force. But business trust, before paying rental income to unit holder, it is required to deduct TDS. For non-resident, TDS will be deducted at rates in force. For resident, TDS will be deducted at the rate of 10%. So till here, are you clear? Everybody? Next. We need to discuss about other income. See, till now we discussed about rental income, interest income, dividend income. All these three incomes are taxable in the hands of unit holder. They are not taxable in the hands of business trust. But if there is any other income means other than rental income, interest income and dividend income. If there is any other income, capital gain or any other income from other sources, other income, this other income is exempt in hands of unit holder. Exempt in hands of unit holder. Give me 1 second. I am getting an important call. Hello. Am I audible? I am sorry, it's very important, urgent call. So that other income exempt in hands of unit holder, but it is taxable in hands of business trust. So very simple. What business trust is doing? Business trust is basically an mediator. Amount received from SPV or real estate property that is passed on to unit holder. So interest, dividend, rental income, these three are exempt in hands of business trust and taxable in the hands of unit holder. Whatever the other income is there, other income is exempt in hands of unit holder and taxable in the hands of business trust. Are you able to understand? That is the concept. Now, what are the tax rates? For long-term capital gain under section 112, tax rate applicable is before 23rd July, tax rate is 20%. On or after 23rd July, tax rate is 12.5%. Short-term capital gain under section 111A, 15% before 23rd July. On or after 23rd July, tax rate is 20%. Other income is taxable at MMR, maximum marginal rate. What MMR? See, business trust is nothing but it can be AOP or BOI. So if it is paying taxes under default tax rates, then MMR is 39%. If it is paying taxes under optional tax rates, MMR is 42.744%. Are you able to understand? Sir, section 112A, actually section 112A was not given in the section. No clarity was given with regard to section 112A. If you take rigid interpretation, even long-term capital gain under section 112A is also taxable at maximum marginal rate. That's why as long-term capital gain under section 112A was not discussed in taxation of business trust, in Finance Act 2025, amendment was made. Long-term capital gain under section 112A was also included. For long-term capital gain under section 112A, it is taxable in the hands of business trust at the rate of 12.5%. Are you able to understand? That is as per Finance Act 2025. For you, Finance Act 2024 is applicable. For Finance Act 2024, no clarity was given with regard to long-term capital gain under section 112A. So if you take very rigid interpretation, in the hands of business trust, long-term capital gain under section 112A is also taxable at MMR. I hope you understood, Niranjan. But this whatever this gap is there, this gap was amended through Finance Act 2020. Next, for example, I will tell one simple example that is applicable for business trust, investment fund and securitization trust. Listen very carefully. Business trust is there, unit holder is there, and SPV or real estate property is there. Now, business trust received income 80 crores. Out of 80 crores, 20 crores is capital gains, 60 crores is business income, or 60 crores is rental income. Now, from business trust, unit holder received 8 lakh rupees. 8 lakh rupees. Out of 8 lakh rupees, same proportion. Whatever the proportion in which income is received by business trust, in which proportion income was received, let's say here income was received in the proportion of 2:6. Capital gain to rental income 6. Let's say unit holder received 16 lakhs. Even the 16 lakhs is also to be apportioned in the ratio of 2:6. 2:6 means what? 2 by 8, 6 by 8. 2 by 8 means 16 into 2 by 8, it will be 4 lakhs. 4 lakhs is capital gains and balance 12 lakhs will be considered as rental income. So the point here is, whatever the proportion in which income is received by business trust, in the same proportion income is also taxable in the hands of unit holder. Are you able to understand? I hope you are clear till here. See, 115 BAB still exempt. Okay, one student is asking, sir, if SPV opted 115 BAB, 115 BAB is applicable only for manufacturing. If property is already constructed, then 115 BAB is not applicable. 115 BAA is only applicable. What business trust will do? It will invest in SPV, already constructed property. Okay. Another small concept is there. If we finish this concept, business trust is over. Listen to me. Amma fan ikkada. Sir, if business trust holds 30% shares in SPV, see, that concept is not possible if minimum 50% or more is invested, then only the concept of business trust is established. I'm going to tell one example now. Listen, you will understand. Let's say there is Umasankar. Uma is owning 80% shares in Lulu Limited. Shares in, there is one company, Lulu Limited. Just give me 1 second. So, let's say I am 80% shareholder in Lulu Limited, but I wanted to create one business trust with the name Lulu Business Trust. Now, what I will do? Uma is there, Lulu Limited is there, and I will create one new trust called Lulu Business Trust. What I will do? I am holding 80% shareholding now. I will transfer 60% shareholding of Lulu Limited to Lulu Business Trust. In return, what I will receive? In return, I will receive units of Lulu Business Trust. Am I correct? So here what is happening? Actually, I am having one company, but I don't want to own that company completely. I wanted to create business trust. So I created business trust. So after creation of business trust, what I am doing? I am transferring my shares to Lulu Limited, and from Lulu Limited, sorry, I am transferring my Lulu Limited shares to Lulu Business Trust. From Lulu Business Trust, I am taking units. So here I hold more than 50%. So we can, what like more than 50% of shareholding is transferred to Lulu Business Trust. Now Lulu Business Trust is holding 60% in Lulu Limited, which is more than 50%. So we can tell Lulu Limited as SPV. Are you able to understand? Special purpose vehicle. In this case, whatever here there is exchange, exchange of what I am doing, exchange of units of Lulu Limited to receive units of Lulu Business Trust. This exchange is not treated as transfer and no capital gains are required to be calculated. Section 47 is not applicable. Are you able to understand? So this is the concept. I hope you understood, Niranjan. So if anyone wants to create a business trust, in that case, what they will do, whatever the more than 50% shareholding that they are holding, they will transfer to business trust. From business trust, they will receive the units. Thereby, business trust holds more than 50% shareholding in Indian company, which is also called as SPV. Now, here there is exchange of Lulu Limited shares to receive units of Lulu Business Trust. This exchange is not treated as transfer and no capital gains are required to be calculated. Are you able to understand? Next, shall I explain investment fund? Are you clear with business trust? See, Niranjan, prima facie, any business trust is formed to invest in special purpose vehicle to make investment of 50% or more. Till after creating business trust, let's say here Lulu Business Trust invested 10% in Reliance Limited. From Reliance Limited, it receives dividend. The dividend is taxable at maximum marginal rate. Are you able to understand? That is the concept. If investment is 50% or more, uh, SPV is formed. From SPV, dividend income exempt in hands of business trust and taxable in hands of unit holder. If it is not a SPV, other than from SPV, if dividend income is received, it is taxable at MMR. I hope with this explanation, you got further clarification. Next, investment fund. Niranjan is there or not? Now, investment fund. See, generally, to make investment in startups or to make investment in venture capital entities, the concept of investment fund works. So, if you want to set up any investment fund, your investment should be more than 1 crore rupees. Normal people, we cannot set up investment fund. It's not like business trust. If you have 2000 rupees, 3000 rupees, you can purchase units of business trust. But if you want to set up any investment fund, your investment should be more than 1 crore rupees. So, bada people will do the concept of investment fund. Are you able to understand? Now, I will explain to you. Very simple. Unit holder will make investment in investment fund. What investment fund will do? It will invest in shares, it will invest in securities, or it will invest in startups. From all these, income will be generated na. Whatever the total income is there, that will be passed on to unit holder. Passed on to unit holder. So total income other than PGBP income. Other than PGBP income. PGB, let's say investment fund earned PGBP income. That PGBP income is taxable in hands of investment fund only. Are you able to understand? So very simple. Yeah, like I set up a investment fund, but minimum investment should be more than 1 crore rupees. In investment fund, I invested 6 crore rupees. What investment fund will do using this 6 crore rupees? It will make diverse investment portfolio, shares, securities, gold, startups. It will make investment and it is going to get income. Whatever the income received by investment fund is there, it is not taxable in the hands of investment fund. It is passed on to unit holder. It is taxable in the hands of unit holder except PGBP income. PGBP income received by investment fund is not tax. It is taxable in the hands of investment fund only and not taxable in the hands of unit holder. Are you able to understand? Yeah, these chapters takes less time to prepare and you will get around 5 to 7 marks. Definitely, business trust, investment fund, securitization trust, easily you will get 5 to 7 marks. And whatever the revision that I am doing, it is more than sufficient. I am doing revision in a very slow way. Okay, this is more or less like a regular class only. Now, so very simple, unit holder is there, investment fund is there. In hands of investment fund, total income is exempt, PGBP income is taxable. Vice versa, in the hands of unit holder, all income is taxable, PGBP income is exempt. Sir, why PGBP income is exempt? Because already investment fund is paying tax on PGBP income, na? So that's why it is exempt in the hands of unit holder. Are you able to understand? Now, see this total income is taxable to unit holders, right? So before distributing this total income, TDS is required to be deducted by investment fund under section 194 LBB. Rate of TDS. In case of non-resident or foreign company, TDS rate is rates in force. In case of resident, TDS rate is 10%. If you remember, in TDS TCS chapter, I have told you 194 LBA, 194 LBB, LBC, I will discuss with business trust, investment fund and securitization trust. Now time has come. Here I explained you TDS under section 194 LBB. Okay. Next. Sir, PGBP income is taxable in hands of investment fund, right? What is the tax rate? If investment fund is partnership firm or LLP or company, then tax rate is 25% or 30%. If investment fund is AOP or BOI or any other person, then tax rate applicable is MMR, maximum marginal. So are you able to understand? In hands of investment fund, total income is exempt other than PGBP income. In hands of unit holder, total income is taxable other than PGBP income. In hands of investment fund, PGBP income is taxable. Now, what is the tax rate? If investment fund is partnership firm, LLP company, tax rate applicable is 25% or 30%. If it is AOP, BY or any other person, tax rate applicable is MMR, maximum marginal rate. So till here, are you clear? Now, here one important point is there. Sir, can you explain how investment fund receive PGBP income? So, investment fund can also do business now. Let's say investment fund itself started a startup and investment, let's say I am having 8 crore rupees with me. I started venture capital firm or I started investment firm. Okay, through that investment fund only I started one startup. So it can get, yeah, MMR new scheme 39%, old scheme 42.744%. So investment fund itself can generate PGBP income. Now, see, listen very carefully. In the hands of unit holder, all incomes are taxable other than PGBP. In hands of investment fund, all income is exempt. PGBP income is taxable. So, if there is any PGBP loss will be carried forward by investment fund only. Other head losses will be carried forward by unit holder. Are you able to understand? So let's say other head losses are there. Those losses will also be passed on to unit holder. Just like how incomes are passed on, similarly losses are passed on to unit holder. Unit holder can do set off and unit holder can do carry forward. But if there is any PGBP loss, PGBP loss can be set off only by investment fund only. Here important point is there, whatever the other head losses are there, they can be carried forward by unit holder only if period of holding is more than 12 months. Are you able to understand? So only if period of holding is more than 12 months, that carry forward is possible. Otherwise losses cannot be carried forwarded. Those losses are dead losses. Those losses will lapse. Those losses investment fund cannot set off, unit holder also cannot set off. So unit holder should hold units for more than 12 months, then only whatever the losses of investment fund are there, those losses will be passed on to unit holder. Are you able to understand? This is the concept relating to investment fund. I hope you understood this concept of investment fund. Did you understand? Everybody? Are you clear? Shall I explain securitization trust? Next, securitization trust. Yeah, only see unit holder is holding units in investment fund. Whatever the units held by unit holder are there, those units are to be held by unit holder for more than or equal to 12 months. For more than 12 months, then it is long term capital asset. Everybody, whoever are there on live, did you understand this point or do you want me to explain once more? Everyone should respond. Did you understand this point? This point. Next, I will start discussing securitization. Do you know ARC, Asset Reconstruction Company? You would have studied in your AFM, Advanced Financial Management. Do you know ARC? Securitization. I will explain very practically with one small example. You will clearly understand. Okay. So there is a one bank, HDFC Bank. And there is Asset Reconstruction Company. And there is investor. Now investor invested 1000 crores in asset reconstruction company. This is investment. See, whatever the loans are there, loans are sold by HDFC to asset reconstruction company. Let's say HDFC gave loans of 500 crores. Now, when HDFC will get back these 500 crores after 15 years, 20 years. Now, it takes lot of time because repayment will be 10 years, 15 years, 20 years like that. But HDFC right now wants liquidity. It wants cash so that it can issue fresh loans. So what HDFC did, HDFC sold all these loans for rupees 550 crores. That means what? HDFC got instant profit 50 crores. Instant profit 50 crores. Are you able to understand? Now, asset reconstruction company sold loans for 550 crores. Now, asset reconstruction company realized 650 crores. How much asset realized company realized? 650 crores. What is cost to it? Cost is only 550 crores. So how much is income of asset reconstruction company? 100 crores. This 100 crores is not taxable in hands of ARC. This 100 crores is taxable in hands of investor. Are you able to understand? So very simple. Securitization trust or asset reconstruction company, what it will do, it will purchase bad loans from bank, it will realize all the bad loans and it will make money. Whatever the income made by securitization trust is there, it is not taxable in the hands of securitization trust, it is taxable in the hands of investor. Total income, okay, total income including PGBP income. This total income is exempt in hands of securitization trust. But this is taxable in hands of business trust. Sorry, taxable in hands of. Very simple. Simple example, what asset reconstruction company will do, it will purchase bad loans or NPAs or it will purchase good loans also and it will pay lump sum amount. Whatever the loans purchased, these loans will be realized by asset reconstruction company. Whatever the realization is done, from that income or loss will be calculated. Whatever the income by securitization trust is there, total income is taxable in hands of investor only and it is completely exempt in the hands of securitization trust including PGBP income. Sir, here we got income. What if there is losses? Even losses are also passed on to investor. Here, period of holding greater than 12 months, that concept is not applicable. That concept is applicable in investment fund. That concept is not applicable in case of securitization trust. Is it clear? Very simple. Income made by securitization trust exempt in hands of securitization trust, taxable in the hands of investor. If there are losses to securitization trust, all losses will be passed on to investor irrespective of period of holding. 12 months period of holding concept is not applicable in case of securitization trust. It is applicable only in case of investment fund. So did you understand? This is the concept relating to securitization. Now shall we discuss advance tax and interest? Once repeat losses point, sir. Asset reconstruction company is there. Next, bank is there. And investor is there. From bank, loans, 500 crores are taken. Paid 500 crores. Example. But realized amount is 420 crores. What is cost to ARC? Cost to ARC is 500 crores. Now, is there income or loss? Loss of 80 crores. Whatever loss of 80 crores is there, this is passed on to, and this loss cannot be set off by, asset reconstruction. Is it clear? I hope you understood, Madhavi. Losses for investment fund, please repeat, sir. Okay, I will explain to you. Investment fund is there. Unit holder is there. Investment fund got TGBP loss 80 crores. This will be set off by investment fund only. Investment fund got capital loss. Capital loss is 10 crore rupees. Let's say I purchased unit on 10th June 2024. Now, whatever capital loss of 10 crore rupees is there, this will be passed on to unit holder. But I purchased on 10th June 2024. At the end of the year, my period of holding is less than 12 months. So, whatever loss of 10 crores is there, it will not be passed. Generally, other losses other than PGBP, remaining losses of investment fund, they will be passed on to unit holder. But unit holder should hold units for more than 12 months. Then only unit holder can get losses from investment fund. Otherwise, unit holder will lose that losses. Are you able to understand? Those losses will be dead losses. I hope you understood this concept, Niranjan. Niranjan, are you there? Good. Now, so we are done with business trust, investment fund and securitization trust. Now I will explain advance tax. See, generally, as per normal rules, income tax is paid on a yearly basis. If income tax is received every year, but in between months, see, if everyone pays income tax in the month of July and October, for remaining months, government will not get revenue. So the government introduced the concept of advance tax. So every quarter, every person is required to assess his total income. Based on his assessed total income, he is required to calculate tax liability. If tax liability is 10,000 or more, then every person is required to pay advance tax quarterly. Are you able to understand? So if you see one movie, there is one movie called Ready movie. In that Ready movie, Brahmanandam is the auditor. He will ask, he will ask for how many times tax will be paid every year. They will tell, like hero Ram will tell, advance tax, like tax will be paid 4 times a year. So when Ram said 4 times a year, it means he is saying advance tax. Okay, advance tax will be paid 4 times a year. Okay, now, so whatever this concept of advance tax is there, advance tax is payable on quarterly basis, but some exceptions are there. In case of resident individual, if he is having PGBP income, and if PGBP income is not there, then advance tax provisions are not applicable. But in case of resident individual who is a senior citizen, I'm sorry, who is a senior citizen. Senior citizen means what? Greater than or equal to 60 years. So in case of resident individual who is a senior citizen, if he is not having PGBP income, he is not required to pay advance tax. But if he is having PGBP income, then he is required to pay advance tax. Are you able to understand? Advance tax provisions are applicable. How to calculate advance tax? Next concept. Very simple. Like first what you will do, you will estimate total income of SSC. If you don't mind, in CMA final class, I have discussed advanced tax concept. Whatever that running notes is there, I will display that running notes and I will explain to you. It will be easy for you also. Okay. Uh, who said iPad will not struck? I am using this iPad from morning continuously. So this got struck. So how to calculate advance tax? This running notes, if you want, I will share with you. Not a problem. Today, CA Inter, CMA Inter batches got started. In next 20 days, CMA final, CA final regular batches will start for May 2026. Hectic schedule from August 25 onwards. CA Inter, CMA Inter, CA final, CMA final, at the same time YouTube videos. Note taking app name. Nowadays I am using Notability. Previously I used it to use Kolla Note. So how do we calculate advance tax? First, we estimate total income of SSC. So as on 1st April of the previous year, we should estimate what will be the total income. On estimated income, we should calculate the estimated tax liability. If estimated tax liability is less than 10,000 rupees, then advance tax provisions are not applicable. Only if estimated tax liability is either 10,000 rupees or more than 10,000 rupees, then only advance tax provisions are applicable. Are you able to understand? Now, then we will estimate TDS credit, TCS credit, relief under section 89 or 91. After estimating it, we are going to calculate balance tax liability. If balance tax liability is greater than or equal to 10,000, then only advance tax provisions are applicable. Otherwise, advance tax provisions are not applicable. Are you able to understand? Now, I took one example. Kartikeya is there. His age is 21 years. he is resident in India and paying taxes under DTR. DTR means default tax regime. Salary 1,50,000 per month, rental income 40,000. Now, how much is his total income? Salary 1,50,000 into 12 months, 18 lakhs. Amma, from rental income, we will claim standard deduction 75,000. After claiming standard deduction, income from salary is 17,25,000 rupees. And we will calculate rental income. Rental income is nothing but net like rental income is not income from house property. If you remember income from house property provisions, rental income will be considered as gross annual value. Then on such gross annual value, we will claim standard deduction. Thereby, I arrived income from house property 3,36,000. So, how much is my total income? 20,61,000. So, on 20,61,000, estimated tax liability is 3,20,630 rupees. So, from this 3,20,630 rupees, second step is calculation of tax liability. Third step, what I will do? I will also estimate TDS. On salary, TDS will be deducted. Na? Here salary is 17,25,000. On salary, employer will deduct TDS. Na? So here employer estimated TDS. Salary is 17,25,000. On 17,25,000, TDS is 2,15,800. Are you able to understand? So very simple. My total income is 20,61,000, but TDS was deducted on 17,25,000. My tax liability is 3,20,630. My estimated TDS is 2,15,800. What is the additional tax liability that I have to pay? Additional tax liability is 1,04,830, which is greater than 10,000 rupees. So whatever the balance tax liability is there, it is more than 10,000 na. So advance tax provisions are applicable. Advance tax is required to be paid in 4 installments. So for every quarter, advance tax is paid. What is the due date? For first quarter, April to June, due date is 15th June. For second quarter, July to September, due date is 15th September. For third quarter, October to December, due date is 15th December. For fourth quarter, January to March, due date is 15th March. Very simple to remember. Every quarter, last month 15th is due date for payment of advance tax. So here you can see on or before 15th June. That means first installment, minimum 15% advance tax is required to be paid. For second installment, minimum 45% advance tax is required to be paid. For third installment, minimum 75% advance tax is required to be paid. By fourth installment, that means before 15th March, 100% of advance tax is required to be paid. Are you able to understand? So these are the due dates: 15th June, 15th September, 15th December, and 15th March. So till here, did you understand, everybody? Comment. Now, do you remember 44 AD presumptive income? So those who are paying taxes under 44 AD, 44 ADA, for them 4 installments are not there. For them, like that means they are not required to pay advance tax in 4 installments. It is sufficient if they pay advance tax in a single installment. For them, there is only one installment due date, that is on or before 15th March. So on or before 15th March, they are required to pay advance tax in a single installment. Because for them, presumptive provisions are applicable. Presumptive income is calculated on turnover or gross receipts. How do we know turnover or gross receipts at the beginning of the year? Not possible na. So for advanced tax installments concept is not applicable. Those who are paying taxes under 44 AD ADA, they are required to pay entire advanced tax in a single installment on or before 15th March. Is it clear? Next, returned income, assessed income, returned tax, assessed tax. See, I filed my income tax return. As per my income tax return, my total income is 15 lakh rupees. So whatever the income that I disclose in my ITR is there, that income is called as returned income. On returned income, whatever the tax liability is there, that tax liability we call as returned tax. Are you able to understand? Next. After I file my income tax return, we have discussed assessment procedures in last lecture. You know, like intimation will be generated by system, or assessing officer will do scrutiny. He will do scrutiny assessment 143.3, or income escaping assessment will be done. So whatever the income assessed by assessing officer is there, that income we call as assessed income. On assessed income, whatever tax liability is there, that tax liability we call as assessed tax. Very simple. I disclosed 15 lakhs. Income tax officer has done assessment. He disclosed income as 18 lakh rupees. So whatever 15 lakhs I disclosed in my ITR is there, 15 lakhs is returned income. Tax on 15 lakhs is returned tax. Thereafter, addition was done by income tax officer, like 3 lakhs addition. Income determined by assessing officer 18 lakhs. Whatever the income determined by assessing officer is there, that we call as assessed income. On that 18 lakhs, whatever the tax is there, that tax we call as assessed tax. Are you able to understand? That is the difference between returned income, returned tax, assessed income, assessed tax. You need to know the difference, because interest under section 234C is calculated on returned tax. Interest under section 234B is calculated on assessed tax. Are you able to understand? So that's why you need to know the difference between returned tax and assessed tax. Now, we will discuss interest under section 234B. Shall I discuss 234B? Everybody? Let's say previous year 24-25 is there. Corresponding assessment year is assessment year 25-26. Now, in previous year 24-25, there are 4 due dates na, for payment of advance tax: 15 June, 15 September, 15 December, 15th March. Within these 4 due dates, if I do not pay advance tax, then I need to pay interest under section 234C. Very simple. If you do not pay advance tax on time, interest under section 234C will get attracted. Are you able to understand? Interest under section 234B. It will be levied from 1st April of assessment year. From 1st April of assessment year up to date of completion of assessment. Interest will be levied under section 234B. Once previous year is over, no concept of interest under section 234C. After completion of previous year, starting from 1st April of assessment year, interest under section 234B gets attracted. Are you able to understand? Good. Next. See, you like ITR due date is there 31st July or 31st October. You did not file ITR within the due date. For not filing ITR within the due date, whatever the interest that is levied, that interest we call as interest under section 234A. So for late filing of ITR, whatever the interest that is levied, that interest will be levied under section 234A. So very simple. Interest under section 234C, it is calculated on returned tax. Interest under section 234A, 234B, these will be calculated on assessed tax. So this is summary to understand. Next, shall I explain further? We will discuss interest under section 234B. Interest under section 234B gets attracted in two cases. Either if you do not pay advance tax, interest under section 234B is attracted. You had paid advance tax, but advance tax paid is less than or equal to 90% of assessed tax. In this case also, interest under section 234B gets attracted. Now, sir, how to calculate on which amount interest under section 234B is applicable? Interest under section 234B is applicable on shortfall amount. So what you will consider, if advance tax was not paid, you will take assessed tax. From assessed tax, you will take credit, TDS, TCS credit. You will take relief under section 89 or 91. You will calculate shortfall. Whatever the shortfall is there, on shortfall, interest will be calculated under section 234B. That means on total tax liability, interest is not levied. From total tax liability, TDS, TCS credit, relief will be reduced. On balance income only, interest under section 234B gets attracted. If we have paid advance tax, whatever the advance tax paid is there, that is also allowed as relief, and only whatever the balance shortfall is there, only on balance shortfall, interest gets attracted under section 234B. Is it clear? Sir, what is the duration? Interest under section 234B will be calculated from 1st April of assessment year till date of completion of assessment. Rate of interest is 1% per month or part of the. Is it clear? This is about interest under section 234B. I already told you, within current previous year, 4 advance tax due dates are there: 15 June, 15 September, 15 December, 15th March. Within these due dates, if advance tax was not paid, then interest under section 234C gets attracted. Are you able to understand? But interest under section 234C is not calculated on assessed tax, it is calculated on returned tax. Returned tax means tax on returned income. So you will take tax on returned income. From that, you will take TDS or TCS credit. You will claim relief under section 89 or 91. You will get balance tax liability. Whatever balance tax liability is there, if it is greater than or equal to 10,000, then interest under section 234C gets attracted. So, what is the amount? On or before first quarter, on or before 15th June, minimum 15% advance tax is required to be paid. So, 15% will be compared with actual advance tax paid. Whatever the difference is there, shortfall. On such shortfall, interest will be levied at the rate of 1% per month for 3 months. Are you able to understand? Next. Second due date is 15th September. Minimum 45% is required to be paid. That will be compared with actual advance tax paid. Difference is shortfall. On the shortfall, interest will be levied at the rate of 1% per month for 3 months. Is it clear? Next. Q3, 15th December is due date. Minimum 75% advance tax is to be paid. That will be compared with actual advance tax paid. Difference is shortfall. On the shortfall, interest will be calculated at the rate of 1% for 3 months. Last due date, last quarter due date is 15th March. Before 15th March, 100% advance tax is payable. That will be compared with actual advance tax paid. Difference is shortfall. On such shortfall, interest is applicable. Rate of interest 1% per month for 1 month. Because see, after completion of previous year, 234B comes. So 234C is up to March only. Due date is 15th March. If you do not pay before 15th March, for next 15 days, rounded off as 1 month, 1 month interest will be calculated. Are you able to understand? Interest under section 234A. I have already told you why interest under section 234A gets attracted. Interest under section 234A gets attracted for late filing of ITR. If you file your ITR lately, then you are required to pay interest under section 234A. So, two cases. If you file ITR lately, then interest will be calculated from first day after the due date. First day after due date till date of actual ITR filing. But you have not filed ITR at all. You did not file ITR at all. In that case, interest under section 234A will be calculated from first day after the due date up to the date of completion of assessment. Okay. What, like, interest is again not calculated on total tax liability. Interest is calculated on shortfall. Assessed tax, from assessed tax you will take credit of TDS, TCS, relief, advance tax paid. If you have paid any self-assessment tax, that also you will take as credit. Whatever the balance shortfall amount is there, on such shortfall you are required to pay interest under section 234A will be calculated. Is it clear? So this is the concept. Next, there are 4 incomes: dividend income, capital gain income, winnings, winning from lottery, betting, gambling, horse races, 115BB income, 115BBJ, winning from online games, first year PGBP income. These 4 incomes are not predictable. Na? How can you, let's say I am having 1 lakh shares in Wipro Limited for 25-26. How much dividend Wipro Limited pays? How can I expect? That is not possible. Na? That is the decision of board of directors. So whatever these 4 incomes are there, dividend income, capital gain income, first year PGBP income, 115BB, BBJ income. These 4 incomes are unpredictable. So for these 4 incomes, even though you do not pay advance tax, that is fine. But the quarter in which you get these incomes, from that quarter onwards, you are required to pay advance tax. Let's say I received a dividend in the month of November. November falls under Q3, October to December. So if I receive dividend income in the month of November, on such dividend income, I am required to pay advance tax in third quarter. 75% advance tax I have to pay. That is the concept. Are you able to understand? So this is all about business trust, investment fund, securitization trust, and advance tax and interest. Hope clear revision was done. If you have any doubts, you can ask me.